Okay, I think we are live. Hello, testing. If anyone is watching this right now, if you can hear me, can you just kindly type yes in the comment box? Usually there's a little bit of delay. I understand that. All right. So we will just proceed. Okay. If you have problem hearing us, please let us know as well, because I have no feedback. Okay. I don't know whether my voice gets transmitted over the air. So welcome to another episode of our AMA Ask Me Anything session with the fund managers. And today I'm very proud to bring you Mr. Lee Kian Soon, who is currently the CEO and hedge fund manager of Astral Asset Management. And prior to that, he has served as an executive director and chief operating officer of a Hong Kong family office for 7 years. And even earlier, in his younger days, he was a management consultant at McKinsey and Company, right? So he has a broad range of experience in investment, corporate finance, and asset fund management in Asia Pacific. If you have any burning question, please type your questions in the comment box and we will address them as and when appropriate. All right. So I will just kick off the first question. Okay. Since we're at the start of the year, it's good to know a little bit of what you think this year's outlook is going to be. Kian Soon.
All right. Many thanks to Alvin for the kind introduction. I think the outlook for 2021 has always been a very popular questions that that emerges since end 2020. As you know, the year 2020 we have a very tough year because of COVID-19 pandemic. And then when we look at 2021, the main questions people ask is what would markets and investments look like? And I'll try to give a very short and sweet answer, and then we bring the discussion to the next level. But I see that the markets and investments in the coming year will be driven by the following three factors. Number one, it will be economy recovery. I think last year is the first time we've seen that most of the developed countries has actually suffered a huge economic loss. Most economy contracted. IMF estimated globally we contracted around 4.4%. I think even in the developed markets like United States, United Kingdom, and developed Japan, and many developing countries, including India, Indonesia, and countries in Southeast Asia, all suffered economy contraction. In this part of the in this part of the world, in Asia, I would say probably you have only one or two countries that escaped this. China is one of them, and came in full year for 2020 at a economy growth of around 2+%. This is very low. So in the coming year, we are going to look at economy recovery simply because the base has been low set last year. And the reason why there will be economic recovery is I don't think the whole world is going into lockdown for at least 2 to 3 months, like what we have witnessed in last year, March to May, where most of the countries are simply on complete lockdown. I think most countries by now realize that a full complete lockdown like what we have experienced is probably not a very good idea for the whole economy. And they need to do it more tactically. And that's why even if there's going to be a lockdown in the coming year, I think most countries will try to do it at least on a very regional level. The second trend that will be driven by what has happened last year will be central banks will continue to print their money and ultra low interest rate will prevail in 2021. I think this trend has already started last year where money printing of trillions of dollars has come into place, and much more money than what we have printed and central banks have given to stimulate the economies since the global financial crisis. I think this year we will continue to see such trend going simply because a lot of countries, whether they are developed or developing, are in very tough fiscal position as well as economic situation. A lot of their residents will need their help, and politicians have no choice but will continue to print money to help their residents to cope. I think the third trend is definitely something everybody is familiar with, and the word is vaccine. we're going to hear about vaccine, and the market outlook for this year, unfortunately or fortunately, will be shaped by how the vaccine program is being implemented this year globally. The reason I said how is because even though the vaccine is ready for some countries, execution is not going to be straightforward. It's going to take time for the vaccine program to be rolled out across the world. And there are a lot of unanswered questions about how the vaccine will help to cope, each country to cope with the virus. I think this will lead to some form of uncertainty as vaccines are being rolled out across the world in many phases.
Okay.
So for market outlook, my general summary is these are the three key themes that's going to affect how the market perform, and it'll be an interesting and challenging year.
Okay, I want to break down some of the things that you have mentioned, right? So your first theme is that you expect an economic recovery in 2021, right? Because 2020 was a low base to begin with, right? So we should see better numbers this year. And we also experienced, right, that last year the stock market wasn't the economy, right? When the economy was not doing well, but the stock market had a record year. Okay, especially in the US, a lot of all the tech companies did way above expectation, I would say, right? So if that's the case, would you say that the stock market is forward looking? And if the stock market ran so much last year, that's why this year's economy is going to do very well. And how do we actually piece that? Go back to the stock market, right? If we think the economy is doing well this year, what does it mean for the stock market?
So what happened last year was, if we take a step back and look into the year 2020, first 3 months, was actually the stock market was reacting to the pandemic in a way, slightly slower pace. What happened was the number of cases kept going up for the first couple of months, and until until WHO declared that this is going to be a global pandemic. And then we see a major crash across the whole world by March 2020. And, by early April, I think most stock market has corrected itself by more than 20 to 25%. You name any market, I think that was the trend. And then what was interesting, as most of us are locked up at home during the April-May period, the stock market starts to recover. I think that was the trend that I think everybody has observed. And one of the reasons is, I think the sudden uncertainty of the virus has lessened. Everybody realized that this is going to be a major problem. This is not a problem that only existed in Asia. This is a global problem. The level of uncertainty actually starts to decrease, and then people start to think smartly, right? What are the companies that are going to benefit from the virus? No joke, right? We are talking about the ventilator companies. We are talking about the glove companies in Southeast Asia that is producing and producing hazmat suit, masks, gloves. And then we see that certain sectors start to actually shape up, right? Because they suddenly realize that despite the pandemic situation, there is an investment opportunity happening. And therefore, a lot of these companies' share prices start to go up simply because their order books are bursting through the roofs. And of course, the tech companies as well, they benefited from the fact that we are all going to work from home. We are all stuck at home. We're going to watch more movies. We're going to subscribe to more online services, etc. And even online shopping where delivery is made to everybody's home. We saw all these companies benefiting for the stock markets. But even though the stock market has actually come out with a strong rally, let's be clear here, there are companies that are seriously suffer from this pandemic as well, right? We're talking about real estate companies, construction companies that are affected because of the pandemic. And so therefore, the rally could be led by certain sectors. But at the end of the day, if you look into a micro analysis of these companies, a lot of companies have not been doing well. And these are the companies that are worst hit because of the lockdown. And for instance, F&B sector for certain countries, basically they have no customers, or they could only offer takeaways. I think that's a big hit for that sector.
Okay, so you are right to say that I also observe there's this divergence of performances, right, between a group of stocks versus another. The impact of this COVID-19 wasn't fair to every company. It was more than fair to some and worse for a number of people, a number of companies. And do you think this trend will continue as long as this as you say, the vaccination wouldn't be a smooth execution? It'll take probably a while for everybody to be vaccinated. Do you see this divergence in performance going to continue into 2021?
I think there's a diversion across a few dimensions. First of all, I will argue that the first dimension is geography. Why I said so is we will notice that the countries that cope better with the virus, i.e. they manage the virus situation very well, could actually allow people to go back to work. While countries that struggle with the management of this crisis actually ended up in a start and stop situation where they have to go into multiple stages of lockdowns. They call it as a result of different waves of the virus, but the virus is a virus, right? It's just that the management of the crisis demanded that they have stages of lockdown over time, since last year. And this is very detrimental for most business because the moment that you have a lockdown, basically there's no customers for a lot of countries. So if you look at it from a geography perspective, I would say that Asia Pacific in general has coped rather well versus the other regions, and this has helped the factories to continue functioning, the society to continue to move ahead, consumers to be able to go shopping face to face, etc. And this is already one dimension. The other dimension that is interesting is you will notice that countries with huge domestic consumption population can survive on its own, simply because when we do a lockdown, we are doing it by country level. Whether you like it or not, that is how the whole world is performing now. And if you have a lockdown by country level, and if you are a small country, for example, Singapore, you are economically challenged regardless of how much we consume. For instance, we can drink as much alcohol and food and spend all the money we want in Singapore, but it's hardly going to move a needle for the whole economy. Versus if you have a huge domestic consumption and population, for example, China, things could still move around. You could do intra-city travel, business could still continue to function, and life goes back to pretty much normal as long as you can manage the virus well. So this is another dimension that I noticed, right? That will set things apart. The third dimension, obviously, is essential service versus non-essential. There are sectors that are offering essential service. They have no concern, even during the circuit breaker. Their factories are allowed to open to provide gloves, to provide masks and hazmat suit. While certain sectors, if you are not in the essential service sectors, you are definitely going to be affected. And I also noticed another trend would be, at the end of the day, all the businesses, we know they need to have cash flow and they need to have a good backup. It's just like Singapore. If you have a strong cash flow and cash balance, even though your business is affected, your revenue is down and affected, you're not likely to go under. You still can survive. But if you are a business that needs all the cash flow in the world to keep you afloat and you're short on cash, this crisis is definitely going to badly hit these kind of businesses, especially when all the government job support schemes and government grants dries up. This thing is not going to be continuous, right? Last year is a special year where many businesses, for good reasons, actually receive a lot of government aid.
Okay, so have this outlook, right, changed the way that you invest for the funds?
Of course, I'll be very frank that last year what happened was our fund has actually managed to deliver a good performance simply because we have been very reactive. And what I meant by reactive is when we noticed that the whole global pandemic situation has worsened, we realized that this is a time where we should be heavy on healthcare products, medical equipment products, and that really helped us to turn the corner during the March to May months. I would say turn the corner means because every fund or every stock market is so badly hit, and that helped us to get back into break evens for the year. And then subsequently, what we look at is based on what the various criteria I've discussed, right? Where do you want to invest our money? By June, we roughly knew who are the countries that are coping better for the overall pandemic situation. What are the sectors that we want to avoid? Plus, what are the sectors that we want to focus on? This has really helped us to zoom in and basically ultimately turn around the corner and come back in the green.
Okay, and is that since June and until now, is there another wave of change the way that you're going to manage the fund, or is still going to be that consistent outlook that has not changed since June 2020?
I think our views, I would say, has changed very slightly since June. Obviously, the changes, I could be frank, is there were still expectations of a stronger recovery or faster recovery. But as the data comes in and as we are seeing new strain of the COVID-19 virus hitting various parts of the world, resulting in a more transmissible situation, I think we have to, adjust ourselves slightly. For instance, right? I mean, in June, people would probably have expected airline, hotels, hospitality to fully MICE events to fully recover by say March 2021, right? Because it's still 9 months away. I think that thinking has been shaped given what we have seen in the last 2 months since December. I think nobody would say that the MICE or big events are going to come back big time by March this year.
So will you be avoiding this kind of stocks, hospitality, airlines, travel?
Yes, I think we are the reason we avoided certain stocks is basically A, outlook, and B, also we are looking into the company financial situation. A lot of these companies, because of having to cope with the virus situation, their revenue basically depleted by about 80% or 90%. And a lot of companies have to survive based on loans and grants, and this is building up over time, right? And we tend to be very concerned when you have a company that cannot service its loans.
Okay, got it. And we got a couple of questions here. I will just sequence them accordingly. Seems like a lot of them are asking about monetary policies. Okay, the first one from Shi Feng. He's asking, will the gap between economy and stock market causing acceleration in money supply in the market to maintain liquidity? There's too much to handle. So I guess what he's asking is about the massive money printing, right? Is there any consequences?
First of all, there are consequences to everything. I'm not the master economist or the whole world, but if you look at it, any excessive actions by central banks, it would ultimately result in some negative consequences. But I think for most central bankers, the question is if they don't do it now, what else could they do to help their own population, which is a serious matter. We are talking about, probably you won't see in Singapore, but we are talking about people queuing up on the streets for food. Just an update, right? I was told in UK, the number of food banks, which is where they hand out food to the poor, is more than the number of McDonald's. So just figure out that's a serious situation. A lot of people are suffering from hunger, and the government need to keep the people happy in terms of making sure that they have food to eat, and also they have a job. And all this needs money, and you need to pump in money in order for the economy to resuscitate itself and to come back. And to solve the unemployment problem, and also and ultimately, right, is to prevent hungry and angry people burning tires on the streets. This is a scene that we're not seeing in Singapore, but come on, it's very real in overseas situation. So they have no choice; they have to do that, and they also have to keep the interest rate low. And this thing is going to keep going. And the question is, I think, based on what you asked, is the stock market is continuing to accelerate. I think ultimately there's a balance for everything. Something needs to give, and ultimately, if every economist figure out that that if the market has over exerted itself, there will definitely be a correction. When the economy slowly fall into place, the money printing will stop. The interest rate will start rising. So everything will come into a balance, and money printing, like mentioned, right, it's just not happening only in China. It's happening across the whole world. If you look at the developed world, Europe and Japan is in negative interest rates. US is in near zero or zero interest rate. So this is happening across the whole world.
Okay. And you mentioned about that the market is divided, right? There are winners, there are laggards. So with all this money supply coming in, and apparently the winners have been winning, and it doesn't seem to be stopping, right? Would you bet more on the laggards or the winners at this point in time?
So our thinking is we felt that the some of the US markets has been really too hot. That we have seen that happening since last year. I would say that mainly driven by the tech stocks because they form a huge part of the S&P and the other indices, right? So that has caused a huge rally. I think a lot of Singaporeans are very happy about that because nowadays, if you walk around, you can even hear them talking about US stocks in particular. They no longer talk about our local stocks, right? So when you hear people walking past you talking about stocks, it always left me interested, lah. So it's also a sign that, hey, potentially the market, could be running ahead of itself. But if you look at across the whole world, not all markets are like that, right? I mean, we did analysis looking at price to earnings, price to book. If you look at the Asian markets, I think they are at a more logical level that reflects the situation. I think if you look at specifically Hong Kong's, China markets, and Singapore markets, I think the PE ratios are okay. If as of end of last year, if Singapore market is in the rate for full year, Hong Kong market is also in the rate for the full year, right? The other markets like Japan and Korea has done very well, but they also have been laggards for some time. So in terms of PE and PB ratios for certain markets, the Asian market seems to be more logical ground, and that's why we think that given what is the developments that is happening in Asia this year, we have a lot of positive developments. The funds, global funds, will continue would potentially see a rotation coming to Asia.
And that's what I find makes investing a bit more difficult at this point in time because of this divergence. It's like if let's say US is overextended and it crashes, right? It should bring along with all the other countries since US is the leader, right, of the global economy. That's what I think. So I thought that, even if you bet on the laggards, what if US crash, right? Could it bring out together? What's your view on that?
I think there's always an impact across global markets, and US being one of the biggest stock market globally, when they have a correction or it always causes a huge impact to the other markets. But if one of the fundamentals when it comes to investing, and we all are bottoms up fundamental driven guys, is if you buy stocks that has a certain amount of safety in terms of safety of margins, and you buy good companies, the prices might correct itself, but you're unlikely to see huge price corrections. And ultimately, when the market recovers, these stocks will be the first to benefit.
Okay, so don't worry about the distracting small stock market direction, right? Focus on the company and businesses itself. Okay.
Yeah, that's right.
Right. More monetary policy questions from Qi Xiang. Do you see a USD short squeeze looming, considering it's one of the most crowded trade, plus emerging nations have emerging market nations have a wall of USD debt to refinance, but their productive assets are still ravaged by COVID? So it's more a currency question.
Right? Yep, this is a currency question. For those that survived through global financial crisis in 2009, you remember that USD to Sing dollar is 1.24. I mean, and then subsequently that has recovered to around the 1.35 region, and depending on which day of which season you look at, it always varies, right? If you can remember last year March at its worst, we are doing 1.45 for Sing dollar to US dollars. I'm not a currency expert, but I will tell you that wherever there's a crisis, and USD is still the flight to safety currency. Again, as I emphasize, I'm not a currency expert. You need to know that you can only buy a barrel of oil using two things, which I always talk about. One is US dollar. The other one is the gold bar. Yes, in Singapore, you can buy your petrol. You can top up your petrol in Sing dollar, and probably that's only in Singapore. If you try to buy a barrel of oil, you need these two currencies. US dollar is ultimately global currency of choice. We can have a big debate on whether this is going to be the case, but it is what it is for the last decades. And I think you will have a value to play unless there is a replacement mechanism. Yes, I think that there's a lot of pressure as they continue to print money. It will be balanced up by how the world perceive their own emerging market risks. Wherever there's a crisis, people get out of emerging markets currency, and that's a fact. And yes, we have seen this happening crisis after crisis, and that's unlikely to change. I think ultimately it's good to have a more or less a stable US dollars. For Sing dollar, from Sing dollar perspective, MAS, we want to manage this. Some of us will enjoy the 1.24 kind of exchange rate where we can go to Amazon and buy our, American goods, or I bought a bike then, using when the exchange rate was 1.24, Scottish shipped in.
Value buyer.
But hey, you must remember, we do have lots of exports to our business, make a lot of exports. In particular, our manufacturing companies do a lot of exports to United States, and such an exchange rate, right, at 1.24 might not benefit a lot of this business. In fact, it might cause them more harm. So it's something that MAS manage on a band basis. But yeah, I will see that in the short term, there is definitely a squeeze, and that will cause some pressure on the exchange rate for US dollar, Sing dollar.
Okay, time to go shopping, right? So yeah, I always, on the point on, MAS always managed the band, although it wasn't disclosed what kind of currency we are benchmarked against or Sing dollar is benchmarked against, but we can roughly tell, right? USD is going to be one of the main currency in the basket, right? So somehow I always feel safe in the sense that I don't need to hedge anything, even if I have a foreign currency investment, right? Because inherently, I always believe that it is hedged by the central bank already through the management of the SGD. Yeah, so I guess USD is not a big concern. I definitely agree with you. Okay, next question about China. Right, from Xiang again. Do you see China easing monetary policy this year? Noted they have a real estate bubble, but the only way China has grown so far is via debt. Okay, there's quite a bit of things to digest in this question, but maybe let's answer the first part first. Do you see China easing monetary policy this year?
I think they have done enough so far. So I would not say that they will rush in to try to further ease their monetary policy further. That's my perspective, at least for this couple of months. Things evolve fairly quickly in China. And I think so far they have managed it well. Their focus will be to make sure that the current waves of the COVID do not go up further as we go into Chinese New Year, and there will be excessive travel, etc. The second question is, yes, you say that there's a real estate bubble. Okay, I would say that this is not a statement of fact. If you ask different people, they might not agree. Basically, the demand and supply for real estate in China is beyond many people outside China, and therefore, and the reason I said so is because there is still a huge demand driven by urbanization. You must remember that there's still a huge part of the population still living in rural and suburban areas, and ultimately they would have a wish, just like we do not want our children to grow up in a farm. So this demand for real estate is beyond comprehension for city-states like us and a lot of countries. And that's why the government has allowed the property players to continue building and to continue launching real estate. But they have also put in more measures when it comes to debt, property debt that they offer it to the real estate developers. I would say that, okay, this is a problem that the government is fully aware when it comes to, and they would at all costs want to avoid a real estate bubble because it doesn't benefit them in any way.
Yeah. Is there like cooling measures in China as well?
Of course, their cooling measures could be quite drastic. And for instance, they would, in the city of Shanghai, they have recently told the real estate players what kind of price can they launch their units, and they could not exceed that price. So what has resulted was some kind of strange reaction is the property developers do not want to launch their units, right? Because potentially if the price that the government set is below, say, their construction cost, it just doesn't make sense to launch. So yes, by trying to solve certain problems, I think it has led to other issues as well.
Okay. So there are cooling measures there. All right. Okay. On China again, Emmanuel asks, are there news of Chinese central banks withdrawing 78 billion to prevent an asset bubble? Do you see a sell-off coming? I don't know about this news. Do you know about this news?
I do not know, but I wouldn't be surprised to see this kind of headlines. Anyway, 78 billion for China in today's world is small.
Peanuts.
Yes, I mean, just an example, Tencent market cap is 1 trillion US. 78 billion US or 78 billion renminbi, and for a country like in whatever currency, for a country like China is not major. I think the concern is to prevent an asset bubble. I don't think there's a huge concern here, and I'm not sure by withdrawing 78 billion whether you could prevent an asset bubble. Do I see a sell-off coming? I think the question is, do I see a sell-off coming in a China A-share markets, right? I think there's always this concern, but you need to know that way back in 2016 and 2015, 2016, when there's a major sell-off in the Chinese markets are 80 or 90% made out of retail investors. Today, that constitution has totally changed. China moved in a rate that that people do not seems to understand from the outside perspective. Today, I would argue that more than half or even like 70% of their investors are coming from institutions. Retail investors are even investing in mutual funds and through funds in order to get themselves exposed in the investment world. So the constitution has changed. Do I think Chinese market is too hot? I think there are two parts of the Chinese markets, one in Shenzhen and one in Shanghai. If you look at the tech stocks, they definitely looks expensive. But let's be clear, here is a China market for tech. It's normal to get companies with price to earnings ratio of 50 to 70 times. Okay, and the reason is because that is the nature of the market, not because the market is malfunctioning. Do I see a sell-off? I would say at this current situation, given what we have witnessed, and given the fact that this year MSCI needs to have at least 20% of their allocations to Chinese ETFs, I think the institutional support will be there.
Okay, so basically what I hear from you about China is that a lot of the policies or what has been quite executed well, right? That the economy should be functioning well. And also in the stock market, there's a lot more institution participation, which gives stability to the markets rather than the very fickle-minded retail money that goes in and out every day, and that will give some support. So it's a sign that China is really maturing in this direction, right?
It is a very interesting market. As in 10 years ago, everybody would say that China Asia market is a cowboy market, it's premature, etc. But things have moved on from there, right? And we are talking about a market that is slowly learning from its past mistakes. I wouldn't say it's a perfect market. There's no perfect market, as we found out. At the end of the day, I think for foreigners like Singaporeans ourselves, the question is, there is still certain limits for us to even invest in the China Asia markets. I think people could do it through the Hong Kong markets, because Hong Kong itself is a host of many Chinese companies that is listing in the Hong Kong Stock Exchange in Hong Kong dollars, which is equivalent to US dollars. In the Chinese markets, you still have some limitations as individual investors or even as a fund, unless you get certain permits to invest.
Okay, so may I ask if Astral is into A shares?
We are not into A shares. Yeah, we're not into A shares. We are not. No, I wouldn't say that we don't invest in Asia markets because we can do it through the northbound of Hong Kong Stock Exchange. But do I have a permit, a license to trade A shares? The answer is no. Yeah.
Okay. So which means you participate via the Hong Kong Stock Exchange the Stock Connect.
Right.
Okay, got it. Let me see. What's another question? Oh, okay. Qi Xiang talk about that's the news today on about the 78 billion renminbi withdrawal. All right, and repo spiked to 15-month high. Okay, and I think Lin Ben shared the link as well. Okay, thank you very much. Okay, there's another question here. Yeah, I know Bitcoin will come up, and really it came up. Okay, Wilson is asking, what is your opinion on gold versus Bitcoin?
I guess
Classic.
these two assets became very interesting, especially during a pandemic situation and crisis, where the alternatives of the fiat currency is always being raised. I mean, gold has always been the sort of a hedge that has been used globally. I think that is the preferred choice because you could trade gold fairly easily. You can trade gold buying the ETFs. You can trade physical gold as well. I mean, if you really want to keep the feel and touch that thing. Bitcoin, obviously, something that has begun to draw interest again. I said this is because in my lectures in universities, right? It was a huge interest, I think, in the year 2017. I have to basically share the logic of Bitcoin, how it started, etc., etc. And then by 2018, nobody asked me, and nobody wanted to talk about Bitcoin. And the same thing is 2019 and 2020 is the time. By the end of 2020, everybody wants to know about Bitcoin again because very simple, right? The price has drawn everybody's attention. I would say that Bitcoin is something still in the process of being developed. The exchanges and all this are still being in the process of forming up, and I would say the interest level now is definitely higher than, let's say, 2017. But considering the fact that there are still some challenges for people to buy it freely, a lot of you will say that that's not true. But for example, what I mean by buying freely is if you want to buy Bitcoin at $1,000 or $30,000 level, I think that's not a problem. But imagine an institution want to buy a $50 million of Bitcoin. Basically, he has to find an exchange that's willing to do this, etc., etc. It becomes the scalable issue is always there. And I think they also have to consider the fact that Bitcoin does raise a bit of security concern in recent years when some of the exchanges have issues. I would say that this is part of the learning curve again. It's not perfect, but for a lot of institutions, if they have to find something to hedge, I would guess 90% is still in gold. And if they are opening up to a new, alternative currency like Bitcoin, that will definitely, you will definitely grow, but you'll be on a step-by-step basis. I mean, if you are individually buying one Bitcoin or two Bitcoins, basically the consideration is very different for institutions that need to park millions of dollars.
So it's a size issue, and Bitcoin is not at that size yet to have the liquidity to provide that kind of buy and sell transactions for Insti. Right?
Yeah, and there are Bitcoin funds, but at the end of the day, could you get a pricing of a Bitcoin from an exchange on a timely basis? I think this is very important, so that you could report the price to investors. Or again, you could say that this is not an issue, right? I just look at my phone, I know the Bitcoin price, but what you see on the phone, yes, but there's a bid-ask price, and exchanges need to update them for the funds to basically mark to markets. So the considerations for individuals versus institutional funds will be rather different.
Okay, but what I hear is also that you believe that there's some long-term prospect of it, that it won't go away, right? It's here to stay, just as immature at this point in time. Right? Am I right to say that? Okay.
Yeah, I think there will be more developments coming up, or either north or south, and this will definitely cause the price of Bitcoin to be volatile because any positive developments, and improvements will be the market will take it very positively, and then if you have setbacks like securities issues or people having problems accessing their Bitcoin wallets, etc., this will be on the negative side. I think it's all part of development. Yeah.
Okay. Teething problems. Okay. Another hot topic, SPAC, Special Purpose Acquisition Company, right? So in the US,
This
So
is your expert topic, right?
no,
Dr.
it's
Well,
a topic. We like to hear your views.
I
Okay.
think it's definitely doable. I mean, it's been done in the US. The question is there a demand for spec? I mean, whatever, there's nothing that the exchanges cannot do. Yes, it involves revision of laws and involve changes to the existing
Act.
processes, the acts, but it's not something not doable. But I think at the end of the day, demand and supply is very important. I mean, there's no point saying that we ought to do this because the other markets are doing it and are fairly successful. But if there's no demand for such services, then why do you have to do that, right? It leaves a lot of
Yeah. Is it also a supply issue in the sense that I would say because in the US, a lot of all these specs are leveraging on the innovation, a lot of the young tech companies trying to get a listing, and they have plenty of these startups, right? Which are quite mature and quite big already to allow a listing, you see. Whereas for Singapore and Hong Kong, maybe, relatively, we don't have their numbers, we don't have their size, and are we trying to force feed the situation?
I think the in terms of startups, they definitely look for avenues to lease as well. So even our good startups, I mean, we saw an announcement. Grab is looking for IPO. Which market did you choose in the end? There's a reason, right? A lot of these startups have, by the time they have reached the stage where they can be listed, they will have received multiple fundings from venture capitalists, well-known investors who has actually invested in this startup at a certain kind of valuations. And some of these valuations are very rich, right? We've seen it before in all these listings. And therefore, in the selection of a market to lease their startups, they will have picked the richest market that could, offer them the best valuation. And it's not because they're not loyal to, for instance, Singapore, and even though they're Singapore-based company, etc., etc. It's simply because it's driven by the economics, where when they lease a company, they want to find a market that gives them the best economic return because they need to answer to their investors. Second, they also want to look at a market that has a fairly rich valuation. I.e., if for instance a certain stock exchange could only offer single-digit PE for tech, I mean, it's not going to attract as much attention as Nasdaq or even Hong Kong.
Yeah, agree. So you are still arguing from the demand point of view, right? That big startups who want to go listing, you'll go for where you can get the best valuation and the biggest market that can support that valuation as well. All right.
Correct.
Okay. Some questions on electric vehicles, future trends. Jixiang asks, okay, on the theme of electric vehicles, which is very hot now, and electronics, would you place your bets on silver and copper?
So our interest I could share with you, share with the audience at Alvin. Actually, I'm an electrical and electronics engineer by training. Since 1994, when I was still a university student, right? What my key pet project is electric vehicles,
Wow.
and it has evolved. Obviously, it has evolved massively, right? I mean, today we see the electric vehicles are actually on the roads. About more than 25, 26 years ago, we are still looking at the concepts of electric vehicles, and so electric vehicles will have its demand. For instance, not only on silver or copper, it will be on all the lithium batteries, right? I mean, the lithium batteries, all EVs will need to run on some form of batteries that you need to charge, and it creates a whole value chain of minerals or commodities that will be required. But if you look at the whole world of commodities demand and supply, right, it's also interesting that people thought that silver or copper will disappear. But I think so far it's not like they didn't disappear, right? Instead, they continue to consistently be able to meet the demands, and we also need silver and copper for many semiconductors and devices, etc. But I think the whole world, nobody has come out to say, look, guys, bad news, right? I mean, it's really bad news when I say, look, we're going to run out of lithium which is more rare than copper or silver in 2 years' time, because literally what will happen is you will see the prices of all these commodities shooting up like crazy, because you know, we are the stock. We always joke, right? The equity and investors are not the only guys that can see demand and supply, right? The commodity guys are even sharper because they are the guys that is in touch with the day to day to the mining companies. So I don't think there will be a huge surge in terms of their prices, simply because the demand, yes, it will increase, but it will be on a gradual basis. But at the same time, the supply will also continue to increase to meet such demand. You will see a huge spike in prices when you have a mismatch, that there's suddenly a huge demand when you have a vanishing supply. So that's how the whole world works in terms of demand and supplies for across all value chains.
Okay, so which means you think that the bottleneck is not at the commodities level. It's probably somewhere down the supply chain, right?
Yes.
Or even the demand may not be immediate, because maybe the range of the car is still not there, the charging facility not there, so adoption rate is probably slower than rather than a very abrupt change in shoot up in demand.
In 1994, when I did the project, the idea was to see electric vehicles on the roads by the year 2000, because it was you know, the change of the millennia and all this, right? It didn't happen, right? But yeah, it takes time. It takes time for people to roll out electric vehicles on the roads, and a lot of safety concerns, and technology will evolve. You know, let's say you need a certain amount of minerals and is in shortage, they will look for alternatives. They will look for improvements.
Okay, and to write on these future trends besides EV, you know, they are like renewable energy, IoT, cloud, AI, 5, 6G, blockchain. There are a lot of all these trends that are happening right at this point in time. Okay, what are some of these? He is asking what else could change the setting, or what else beyond all these things that we are looking at? Are we missing out something? Because all these are very hot right now, right? Are we missing something else that might change the world even more?
Okay, so these are the common themes that, you know, if you read any analyst reports, or you look at, you know, you go to attend seminars about what's going to be the next big thing, I guess these are probably the obvious answers lah. I'm not a scientist by you know, in my day job, so I don't have something secret or remarkable to tell all of you. I'm sorry. Yes, I wouldn't have anything that, you know, that is outside this list. And that could change the setting, right? So in terms of changing the setting, I think a lot of how these things will evolve. For example, renewable energy, EV, would also require a lot of government directions and regulations. For instance, we see under Trump administration, he has totally no interest in renewable energy, right? So I mean, the climate issue was there, the renewable energy technologies were there, but I mean, Trump has obviously little interest to push any of this. Under a new administration, I could see there's definitely going to be more interest in renewable energy, for instance, etc., etc. So what I'm trying to say here is, yes, the technology are all the big names coming out that we see, right? I think the missing thing here is you know, the driverless cars, for instance, right? Which is a longer time horizon coming up. But all these things will need to be implemented, and you require a lot of execution. It's no point having technology big names, but at the end of the day, for instance, if they couldn't find an app for blockchain, right, to do something that is beneficial to mankind, you know, the technology remains there for the last 10 years, but, you know, people have to find a way to make use of this technology, to make it day to day and to make it beneficial for users before it becomes mainstream.
So something you mentioned is like some part of the problem is not the technology, it's the policies, right? Like renewable energy that you mentioned, and some is like it's more technology. It's like they have a solution, but they don't have a problem to solve. They are looking for a problem to solve. That's what blockchain is at this situation, right?
So a word of caution. I think there's this. I mean, it's right that you when you mention all this, everybody try to find the next big segment, and by doing so, hopefully try to find a company that is going to do very well in each of these segments, and hopefully you could invest and make money out of it. But there are some challenges that come when you use this approach. The reason being that you need to remember a lot of this only the winners will take off. And unless you are very well diversified in each of these segments, you could potentially miss the winner and place your bets on somebody that is not going to do so well. That's one. And that's true for a lot of technology investments, because the winners tends to be the dominating guy, and ultimately they will take it all. And the second thing to highlight is also a long-term investments in all these companies. And if you have no patience, you might choose to take your losses in year 4 and before that guy became a Google or Amazon. Amazon didn't make any money for 15 years or more, right? So you need to have your patience, and you need to place the right bet, and which also makes investments in such big teams very challenging. The final highlight I like to say is, I think in the year 1910 or 20s, everybody knew that motor cars is going to be the next big thing. Everybody knew that horses are all going to be replaced. Okay, just imagine we travel back in time. But at the end of the day, what happened was interesting. What is certain is the number of horses in the road definitely disappeared, because they are all replaced by motor cars. But all the guys making motor cars, not a lot of them became champions. In fact, it's always a struggle to make motor cars and be profitable even until these days. Right? Yeah. In the 1930s, the same thing for airlines. Everybody knew that airline is going to change the world. We are going to fly around like crazy using planes. We are no longer just going to use steamboats or just the cars. But again, in order to run a profitable airline, we have seen how challenging it is, right? Without COVID, and not a lot of airlines are extremely profitable.
Yeah, I think those are very good points, right? Because it's very easy to get sucked into the current trends, the sexy things is, I know this is going to change the world, this is going to change the world. But it takes a lot to change the world, right? And you don't exist in a silo. You have competition along the way, and you wouldn't know who is going to be the winner. And it's still very early. Technology is still changing very fast. How do you know this is going to be a winner, right? So I suppose that the other way is what Astral prefer, which is to invest in those that are more obvious winners already, right? With good cash flow, with good profitability, and those kind of companies. Now, am I right to say that?
I think we have always been cautious in our approach, in terms of looking for the safety margins in our investment teams. But there are times when some of these investments, we also have sort of time ourselves well, so that the company is already starting to make profits, but we are willing to take a position so that first of all, the companies we invested in are all listed. So that is the first margin of safety. I mean, if you invest in a lot of these new concepts, companies, you're probably doing a private investments, because some of them have not even reached the stage where they could be listed in a stock exchange. Secondly is, even if you're listed, there are a lot of companies that looks very attractive in terms of value propositions, in terms of trying to offering customers new fanciful technologies. But when you look at their business model and their financial situation, it tells you completely the opposite picture. So we believe that the advantage of investing in a listed company is you actually have no rush to invest in them, right? You could take your time to do proper research, use the tools that are available from public sources to gather information about these companies, and you can do your observation and see whether the management is really delivering what they promise. I think that is very important, and then you make a decision whether you want to invest in this listed company or not.
Okay, so you brought another dimension, which is looking at the management, right? Because at the end of the day, they are going to be executing all these changes in the future, right? So you have to bet the jockey.
Okay. Yeah. No, I would say that in Asian companies, in particular, my experience is making sure the shareholder and the management are aligned to the minority shareholders is of utmost important. I would say that this is there are people saying that, look, I want to be on the as investors, I like to be able to influence the management, and all this that is only possible if the management is receptive. If you know that the management do not tends to have some issues and are not investor friendly and all this, you're not going to make much changes over time, right? And instead of wasting your resources on such companies, let's move on, man. There are plenty of companies to be for us to pick, and let's just pick the better ones.
Okay, so Astral will never be a activist fund ever.
I would say that in our experience in Asia, trying to be an activist fund is very challenging, especially if you are targeting a state-owned enterprise companies, or you're targeting a company that is tightly held by the key founders and their family members. You could make a lot of publicity in terms of trying to raising awareness for investors, so on and so forth. But the end result could be very limited.
Okay. Because I always see that a lot of activism in US and a lot of cases have worked out well. I always wonder, in Asia, why is there this lack of activism? Is it because of our culture? We're trying to be more harmonious. If you don't rock my world, I don't rock yours. I don't know.
Okay. First of all, right, if you look at there's a history and reasons for that is if you look at most listed company in the United States, the shareholding is never concentrated to the founder family and all this, and the reason is since 1970 everyone knows it's because of taxes. So a lot of listed companies, the shareholdings have been diversified into a lot of institutions with the founders and founders family holding a very small proportion of the shareholdings. The second is the setup of the board in the Western world is definitely more diversified. They have almost all independent directors except the management, the CEO, who is likely to be the founder. In contrast, if you look at Asia, the setup is very different, right?
The whole family is on the board.
Yeah, I've sit on board for many companies, and you realize that the board directors knew each other since their kids going to school. These are very friendly board directors where agendas would have been pre-syndicated, discussed, and confrontation, as you rightly mentioned, is frowned upon. So and also the control of the shares are very tightly held. And usually you could see that family-owned business in Asia is more than 51% owned by the founding family. I mean, this is continue to be the case because there's no laws against it, or there's no tax disbenefits, right? Tax disadvantages. So this is the context, right? And if having understand the context, that explains why activism is very different in the Western world and in Asia.
Good points. All right. There are some questions on specific stocks. Are you comfortable to talk about them? Like, for example, is it time to buy Alibaba? I don't think you can make the call, right?
Okay, I think in there's a concern about regulations, basically.
Yeah, maybe you can answer in terms of that. Yeah.
So this applies to the whole sector, right? I mean, whenever you have in China in particular, right, and it sort of affected all the China-related stocks is when there's in a segment when there's regulation control and all this, people get very nervous. We've seen it for the education segment, right, where a lot of universities were told that if they're charging a fees, you're actually profit seeking, etc., etc. That happens 2 years ago. And now I think the question is now the tech firm got it because of the and it's more in general the concern is whether their behavior is monopolistic in nature. I think this overhang will still be there. I think the government is also, and the regulators also realize that for big players like Ali, Tencent, they have become a Godzilla, right? They are 100 pounds Godzilla standing in the market, and any detrimental actions will cause a lot of a big impact on investors, not the management as well as consumers. Because I don't think anyone can live without Tencent or Ali in China now. So they have become, in a way, in US we will say that they have grown and become too big to fail. And that's true. And I think this regulation overhang will continue. It's also not a bad thing in a way. I see that over time, regulations improve to make sure that you not only benefit a small number of market players. I think it's important how they carry this out to send the right messages across. And I think they will not rock the boat for the sake of just being, the concern is, are they unhappy with certain personality, and that's why they were. I don't think we are looking at the situation at such a micro level. I think they really wanted the whole segment to improve. They are also very concerned about monopolistic action that I think shouldn't happen.
Mm-hmm. Okay, which it seems like a trend is not just in China, but also in the US and even in Europe, right? Against the big tech. Yeah, they're getting so much more powerful than before. Yeah, another individual stock. Okay, I don't know whether you know about this case, the GameStop stock where the retail drum up the share price against short sellers. Were you aware of that incident?
I think it's basically about is this the guys that sell the very nice doll and toys, right? Is that the one you're referring to?
I don't know what they sell, but the case was that a group of people, they are online retail investor, right? They just gang up together to beat up the price. Yeah. So I thought there was a few like significant points that, by right, if you do this in a small group, right, it's considered price manipulation, right? You can go to jail for that. And there are people are doing it online, publicly, and because of all this social media that has made all these communication channels available to unite actions together, right? It sounds like a very interesting case to me. I don't know how it will go forward from here, right? That such that they become like a retail investor where they gang up together, they may have the power to outmuscle certain institutions, right, on certain positions. Yeah.
I think
So what do you think is it even possible? Yeah,
I think
in this
the
case, it was
concept,
possible, lah.
in China, this concept is called 拼多多 lah.
Okay.
We've seen it. I mean, like, okay, like, it's okay when you gather a group of 50 people to try to buy certain products, and therefore, you get discounts, right? You get better discount because you're buying at huge quantities. But I think this kind of concept somehow has also evolved, right? And when it comes to buying stocks and trying to, get excessive interest, you have to be very careful. I do not know you have to be very careful because the level of tolerance will be low for anyone who try to manipulate stock prices, which is strictly illegal in any jurisdiction.
It's just interesting whether there will be any prosecution on this, right? Yeah, it was a very interesting case. I think it's still like a lot of discussion around it at this point in time. Okay, all right, let's not talk about tech stocks now. Let's talk about I think this is REITs, right? Yes, Qi asked again, where do REITs sit in your portfolio considering a low interest rate environment we are going to be in for some time? Does inflationary pressure from stimulus spending and QE change impact the 10-year rate, your outlook for REITs? Okay, so there's two parts of the question again. Yeah, so maybe you can answer the first part first. Yeah.
So I think it depends on what kind of REITs. There are many different forms of REITs, and it depends on which sectors. We have some very selective REITs, and it all depends on outlook. I mean, if we look at strictly speaking, the retail REIT, and we were very negative, especially during the circuit breaker period, because if the malls are closed, they are closed. So that's the obvious answer, and obviously now the concern is the malls are back to normal. The traffic is more or less back to normal. I think would their business be affected in the longer run? The way Astral do our analysis is we always walk around the malls and see whether there are empty stores. I mean, there's no point telling me your average rent is how much per square feet, but if your store is empty, it's still empty. I.e. you have no rent to collect. So we actually kick the tires when we do our analysis, and then the other thing is that has raised a lot of discussion is office REITs, because the working environment has changed. A lot of people are now working from home. So with the demand in terms of office space going to be as strong as before, where all of us have to go to the CBD to work, and we are seeing changing behavior. But of course, some would say that, look, the change is not going to be so drastic because office have their leases. They need to run its due cost. There are also new companies coming to Singapore to open up new offices, etc., and creating employment, etc., etc. So I think the office and retail REIT will continue to monitor. It's not being very attractive at the present moment. While I think industrial REITs to offer some kind of more interesting, or at least more on the positive environment. Strangely, despite the COVID situation, our manufacturing has been doing well. The demand for industrial space for certain area has been continue to be strong. So it all depends on what kind of risks that we talk about when we, for our portfolio. But for every one of them, we already kick the tires and see the demand for whether there's a demand for such asset, i.e., is it office, is it retail? Yes, the low interest rate is going to benefit the REIT because if you look at a REIT, one part of their equation is how much loan have they taken, and the interest rate definitely impact them in terms of financial expenses, so on and so forth. But at the end of the day, if you have a bunch of empty office or malls, touch wood, right? No matter how low your interest rate is, it really doesn't matter. And that's going to affect the DPU, and that really will change. And once the DPU is impacted, investors will walk.
Okay. So I think that's a good point, right? Maybe people are too fixated on the interest rate that they forgot that it's the tenants who pay rent that's more important. Okay. Let me see. What other question? Okay, there's another question, but I think the answer is quite clear. Is it better to invest in stocks or in cryptos? I think to help you answer this question, I guess it's also about how much, right? Whether are you like 100% stock, 100% crypto? Okay, that makes the question a lot easier to answer. What do you think?
Yeah, I think at the end of the day is my obvious answer would say is stocks, right? Anyway, but to make the discussion more interesting is I don't think it's a 1 or 0 question. I think a lot of people will allocate their money to stocks, to bonds, real estates. There are many things that people could choose to invest, and also in gold. We talk about gold and silver. These are also investable assets, as well as cryptos, Bitcoin, etc. So at the end of the day, my advice is don't just put all your money in one, regardless of how confident you are. And you need to spread out your risks. You need to do your own planning, right? It's not like you can only buy one, right? At this day and age, it's not true that you need a certain amount of money that you can buy stocks, right? So you can buy in batch. You can buy in number of shares in smaller quantity, but at least make sure you have enough cash for yourself and your family before you even invest. That's what I would suggest.
Okay, so it's more like a very asset allocation approach, right? So on that note, right, how many stocks do you think an individual should have in terms of the degree of diversification? Do you have a view on this?
Yes, I think okay. First of all, upfront, Astral invest in 50 to 70 stocks, but that's because we do this for a living, day in, day out. We are familiar with the companies already for the last 10 over years. We have been doing this, so we could say that we could own a bigger share for diversifications and all this. As an individual, if I say, look, for anyone to own more than 50 stocks is actually very tough, right? Unless you count the ETF constituents, and I don't think that's fair. So you don't come to me and say, look, I bought an ETF and inside has 30 stocks. I mean, no count lah. I mean, but anyway, for individual, it really depends on your own time. I could say that 25 is the best number, but at the end of the day, if you don't have time for 25, it's actually difficult, right? There's no magic number, but if you say you have one, then I say, hey, that's not a good idea, probably you're not diversifying, and you need to have a couple of stocks to spread around, and you can start with 8, 10, and then as you find ways to manage the portfolio efficiently, you could slowly increase it up. And it depends on how you want to manage the portfolio, right? If you say that my way of managing it is to buy the stocks and don't see for 3 months, then maybe, yes, your active is not very active. And definitely you can do 20 versus a guy who wants to do a summary of the stocks he invests on a weekly basis, right? I recognize that individuals need to, make sure that they spend time with the family, they need to work. So on a weekly basis, doing a review, is a reasonable amount of time for at least 10 to 15 stocks.
Yeah, you have to must like it. Otherwise, I think it's very hard to be sustainable. Maybe some people can do it for 1 month, then after that, I give up already.
Yeah, that's the usual challenge I think individual investors have, because as priorities shift and sometimes the workload increase, you lose it for a couple of months.
Yeah, very, very, very common. Yeah. And Derek has a question. If I want exposure to China market, is it better for me to invest in which currency? USD, Hong Kong dollar, or renminbi? Because I think there are ETFs and funds in different kind of denominations. Yeah, and his
So
primary currency is SGD.
yeah, so if ideally if you can find a fund that is priced in SGD, that is investing in China market, I think that sort of address most Singapore investors' concern. For bear in mind, US dollar and Hong Kong dollar are pegged, so there's not much difference. I.e., they have the same, they share the same exchange rate, and so on and so forth. Renminbi will be a very difficult currency because it's a controlled currency. It's just not easy to be exposed to renminbi because you can't have a exchange that currency on a day-to-day easy basis. Most guys I know, if they want exposures to other markets apart from China, right, there are other markets as well, they will usually pick the US dollar denomination. And a lot of these funds, they actually do rebalancing. It's not like they take your US dollar and do nothing. They will do rebalancing, they will change it to the currency that they need to invest in and do the necessary work.
Okay, so sounds like USD is the primary choice. Shifeng has another question. Invest also made easier through low-cost platform. Will there be some kinds of disruptive in Asian investment market? Okay, I guess he's saying that maybe, the retail participation will go up in Asia because of low-cost platform. Do you think that's going to happen?
Let me give an example of why US brokerage, right? Ameritrade, TD Ameritrade, etc., can give 0% brokerage, right? Simply because this brokerage in US have a certain amount of skill. So they figure out the best way is to ask retail investors to park maybe at least 10,000 US inside their investment account, and they enjoy free trades. The reason being, all this 10,000 multiplied by all the investors in USA is $1 trillion, or hundreds of billions. And just by putting this in fixed D, they cover all their overheads, right? And at the same time, they sell funds or institutions their information on how the retail investors are trading, right? They package it and resell all this information, and that's probably a more attractive revenue than trying to charge a retail investor either a $5 or $10 trade, right? They want the retail investors to trade without thinking, right, about the cost, which is what I think we are talking about here. It's challenging because first, our market in Singapore is not that huge. In Asia itself, which is your context, right, is unless you have such a huge market, I think within China, potentially you could do something like that. But again, it comes to how many players are there in the market that is willing to disrupt this thing. It is a pure market analysis where if you have two oligopoly or three, like what we see in certain markets, there's no point for them to lower the price too, right? You could see that in certain markets, the price of trading a stock is much higher than relative to others. While if you have a bigger markets where there are a lot of competitors and there are guys who are trying to, willing to underprice, then you will have such a situation like what you said, where low cost, is the way to go.
Okay, so it's tough for our small market. Okay. All right. I think I cleared all the questions from the audience, and anyway, we have stretched more than 1 hour. Okay. I'll just ask the last question. All right. Sure. Important question. Okay. What are the opportunities you see in the markets right now?
Okay, that is the next, the best questions that people want to know in terms of what to do in the coming year, right? Based on what we discussed. Yeah. So our analysis so far point to the following is first, in terms of looking for opportunities, we would prefer the countries in Asia that have managed the pandemic situation well. And we also will intentionally avoid countries that have not managed the crisis so well. Very straightforward.
Would you be able to give a bit of examples?
Okay, let me finish, and then I'll give the example, right?
Sorry. Go ahead.
Second, in terms of sectors, right? Pure preference for large domestic consumption sectors, lah. I'm not dependent on somebody coming in to travel based on travel or trade, and there are large domestic markets to consume. And in terms of what are the sectors that we like, is basically the essential, the healthcare and medical care sectors. Surprise, surprise, right? Everybody is definitely more health conscious, whether it's because of COVID or whether it's because of awareness. I think people are willing to spend much more money on healthcare products, medical care devices, etc. Just look at the number of sanitizers that each household buy. The third criteria for us in looking for opportunities is as a result of the COVID, some companies' valuations are badly affected, right? They are beaten down. But at the same time, if you look at their financial statements, you look at their financial health, they have huge cash surplus. They have very little or no debts. These are the companies that we love, right? Companies that will continue to, survive even if there's sudden knee-jerk actions there, which could be possible in this stage. And if you put all these factors together, right? I always say, you put multiple lenses together, we tend to believe that the opportunities are more attractive in a lot of these Chinese companies. I mean, this is the case where they have a large domestic market to continue to serve. They are not worried about pure export kind of a situation, and they have also managed to make sure that the economy continue to function. Last year, I think the whole world's economic growth is negative. China came in 2+%. This year, they're expected to come in north of 8%. I think this is a very good, economic growth despite all the limitations that we have seen. So these are the companies that we continue to target. They with the main presence in Northeast Asia, and a few of other drivers, right? One is we see the RCEP being signed, right? And includes all the countries in Asia. A lot of countries in Asia participating in RCEP. The other driver that I even see is if you look at foreign direct investments, the whole world foreign direct investments in the year 2020 has actually shrunk. But apart from Singapore, two other countries actually grow our foreign direct investments, which is China and India. Why? Whether the United States like it or not, they will still continue to be a huge manufacturing hub for the whole world. So unless Europe can produce better factories and US can rebuild all their factories during this pandemic situation period, you still need somebody to produce your products, whether you like it or not. And if you look at Singapore, I think our manufacturing sector has did our country's economy a big favor as well. So if you look at this, if you are countries surviving on your economy based on consumption, like what we see in the United States and a lot of European countries, you are going to be badly hit because of the lockdown. However, if your economy is more diversified and you have a manufacturing power base, look at China, look at Japan, look at South Korea, and you're producing chips for the whole world, and your factories are labeled as essential services, your economy is not going to be in such a bad shape.
Okay, right. So that's a very interesting take. And I hear China is the #1 country, right? Huge domestic consumption. I think the policies also help, right, with the dual circulation policy and made in 2025. All this policy that's made known to the public. Personally, I also quite invested in China, so I hope you're right, and we can prosper together. Okay, and I guess we have gone through 1 hour 20 minutes, almost 1.5 hours of the interview. So thank you for staying with me past that hour mark. And if anyone who is interested in to invest in Astral Asset Management, we'll just post the link below, and you can just make appointments to meet up with Kian Soon and his team. All right. So thank you very much. Thank you, Kian Soon.
Thank you.
Thank you,
Alvin. Yep.
All right. Good night to all. Bye.
Bye.